Hey. Hi guys, and welcome to Macro Markets, where we analyze how the macroeconomic news and events impact the crypto space. I'm your host, Marcel Pechman, analyst at Cointelegraph and a veteran stock market and derivatives trader. Today's show will start a little bit different because we'll take a step back to understand the difference between fixed income and risk assets such as stocks, foreign exchange currencies, commodities, and cryptos. So, first of all, why do people invest? That seems an obvious question, but I guarantee the answer is not. For instance, if you're age 65 and retired, the main objective of your portfolio is merely balancing out the inflation. On the other hand, if you still got some 20-year plus of activity ahead of you, the odds are your portfolio will favor some risk. Okay, we've covered the basics, but that's not the only reason that people choose between risk on and risk off assets. The macroeconomic environment, more precisely, the expectations for the next couple of years, will vastly influence how people invest. That's what causes the market cycles. Because right now, everybody wants to buy AI. It's the hot thing. Nvidia is at the peak of its pricing and everybody wants a cut. Those movements, those buying spree activities happen due to herd theory. People move in tandem. So if they're seeing everyone investing in AI and it's working out, they want to do the same. So it happens during or next or close to the bubble peak. On the other hand, the long-term bonds or debt instruments paying almost 4% per year aren't exactly hot right now. And that's exactly what caused the yield to move from 3.5% to 4% in 3 weeks. We'll examine the US 10-year treasuries chart. So the yield is how much you're gonna earn if you buy those treasuries today. So if the yield goes up, it means there's low demand because there's less people interested. If the yield goes down, it means that it's hot. Everybody wants in, so it's paying less per year. And you can see here that during May 2023, it spiked from 3.3 or 3.4 all the way to 3.8%. This shows that right now there's less interest on fixed income, at least the long 10-year Treasury notes. People are avoiding those instruments due to the risk of the government or the company's inability to pay their debts. Okay, and what about cryptocurrencies? Why is the market cap some 60% below all-time high when the stock market, as measured by the S&P 500, is merely 13 to 15% below its peak? Well, after 20 plus years trading risk markets, I've came to the conclusion that we'll never know the rationale for each asset pricing. The reason? Each investor will perceive a different risk reward as we move over time. And even the traditional dividend-paying stocks, such as British Tobacco, Telefonica, and Rio Tinto, might suffer if investors believe that the central banks will further raise interest rates, for instance. The truth is, we have a huge problem for crypto's adoption under the optic of portfolio investment. Firstly, it is a category of its own, which doesn't happen to be included in the commodities indexes, nor the foreign exchange rates, the currencies. Moreover, not every mutual fund can access cryptos. They cannot invest directly, and some of them can't hold derivatives and might not even be able to buy the ETF listed in the United States. So it is worse than the chicken and egg problem, because even in the countries that happen to have plain vanilla ETFs, such as Canada and Brazil, where the fund merely buys the Bitcoin and Ethereum not using derivatives, those instruments are seen as extremely volatile because of Bitcoin and Ethereum's volatility. So they're mostly used for hedge and arbitrage. In short, we're still a long way from having 20 or 40 out of the S&P 500 companies using cryptos to allocate a decent chunk of their money. But some argue that the revolution will not start by Apple, Microsoft, and Bank of America. Those big companies and banks might not be buying Bitcoin and Ethereum anytime soon. And instead, it depends on retail, meaning the little guy saving for retirement or simply exiting the failed fiat system. There's no right and wrong, no better solution, and they might as well develop in parallel, both the companies and the retail investors. The most important information I want you to retain is, for now, even if there's a lot of arbitrage bots, the market cycles are utterly dependent on human behavior, human psychology. If Bitcoin and Ethereum are mostly understood as alternative risk assets, that's how they'll trade. So don't waste your time looking for theories explaining why crypto has been unable to break new heights. Now, we're gonna jump to a news on Bloomberg, which says Nvidia short sellers lose 2.3 billion in one day as the stock price soars. Traders betting against Nvidia suffered massive losses as the chipmaker stock surged to a record high after it forecast sales that far surpassed the average analyst estimate. Short sellers are facing 2.3 billion in paper losses on Thursday alone amid the tech giant's 27% intraday jump. Okay, let's stop here for a moment. What is short selling? Sure, it means betting against the stock price of the asset. But how does it even work? In this case, we're talking about margin lending, meaning some holder lended those shares to someone. This borrower sold the stock and will have to rebuy them later to settle the loan. If the price goes down, good for him. But if the opposite occurs, as Nvidia stock rallied, the losses can be gigantic. And what about the article mentioning paper losses? That's because the short seller can endure pain if they don't close the stock borrowing. So, as long as they have enough collateral deposit, those losses are still open. That's similar to a buyer that paid a much higher price for their cryptos that they're holding, and the crypto's price went down. Until this person makes the sale, those losses are not concrete, those are paper losses. The difference is that the short seller needs to find someone willing to lend those shares to keep the trade open. Again, from the article, Nvidia's notional short interest value, the amount of money short sellers have bet on the stock's decline, is more than $9 billion. That makes Nvidia the fourth most shorted stock in the US, behind Apple, Tesla, and Microsoft. Okay, so here's an important piece of data. The four most shorted stocks also happen to be top 10 S&P 500 components. Those are huge companies. That leads us to another issue. Those short sellers might have been market neutral the whole time. For instance, buying S&P index futures and selling the individual stocks. So the biggest mistake literally everyone makes when analyzing short data is assuming that the investor is necessarily exposed to the stock price downside. That's also valid for Bitcoin and Ethereum, both margin and futures trading. So make sure to tone down those big numbers that usually make good headlines. So our second article, also from Bloomberg, goes on by saying, China warnings flash across global markets as growth disappoints. China's muted economic rebound and Beijing's reluctance to deploy large-scale stimulus are reverberating around the globe, crushing commodity prices and weakening equity markets. Recent data suggest gross domestic product (GDP) growth this year will be closer to to the government's target of 5%, contrary to the expectations of a large overshoot formed earlier in the year. So basically, the market got two negative surprises. First, the GDP did not exceed government's target, but more importantly, there will be no stimulus package to inject liquidity and boost the stock market prices. Again, from the same Bloomberg article, China is the world's biggest buyer of items like crude oil and copper, and its vast steel industry accounts for well over half of the global iron ore demand. Now, things get interesting, as there might be a 4D chess here. Considering China's relevance in the commodities import, they could be forcing the US and Europe hands. If the commodities price and the global trade balances continue to weaken, that's less tax for those governments. Remember, it's not like China has just faced two consecutive negative GDP results. In fact, it's Germany that has just entered this technical recession, and analysts expect the US to join the recession club by the second half of 2023. What does this mean for cryptos? Initially, if the global trade and commodities continue to suffer, it drains liquidity from the markets, and investors will further reach short-term government bonds and cash. So basically, very negative for cryptos. What we don't know is how the global currencies will react. But if the US dollar loses strength, that's certainly positive for cryptos in the medium term. So we're talking about late 2024. Well, that's it for today. Hope you enjoyed the show. Remember to like and subscribe to the new Cointelegraph Markets and Research YouTube channel. See you!